Hello viewers! Welcome to our Remarkable Finance channel. Today's video is about taxes. What do we know about tax? Have you ever filled up an income tax return form and paid the corresponding tax levied on your income? Do you and your colleagues pay the same amount of income tax? If not, why do taxes paid by each individual differ? Watch the video until the end to understand the how and why of taxes. Before moving forward, please like, share, subscribe, and click the notification bell to get updated with our new videos. Now, let us start with what is tax. It is the compulsory levy or financial obligation imposed by the government on individuals or entities based on the income earned. As of 2022, U.S. taxation is applicable to various items from salary income to cigarette and gasoline purchases. Inherited properties and casino winnings are charged with taxes too. In almost every country of the world, tax is the main source of revenue to finance government expenditures. What is the purpose of tax? The basic function of taxation is to finance government expenditures. It helps to fund various undertakings such as public works, infrastructures, and wars, including buying of weapons. In some countries, the justification of levying taxes focuses on economic and moral considerations. Finland, Denmark, Ivory Coast, Japan, Austria, Norway, and Sweden are some countries with the highest income taxes paid by the citizens. Paying high income taxes is naturally justifiable because let's say Finland is the happiest and third best country in the world. There is free universal daycare for children and free public school education. Finland has free universal health care for its citizens, which is funded by tax. Norway too has been ranked as the best country to live in terms of education and income, considering life expectancy, human rights, and cultural freedom. Some countries, such as those earlier mentioned, have good standards of living due to the high income tax paid by the citizens to their government. There are two main types of tax. Number 1, direct tax. Example is income tax. Number 2, indirect tax. Example is sales tax. The tax is included in the price of goods or services. Based on impact, there are also two: impact on high income earners and the impact on low income earners. To be more specific, taxes can be under 6 categories. Number 1, income, levied on the wages, salaries, investments of an individual or businesses. Number 2, corporate, imposed on the net profit of a business. Number 3, capital gains, tax on the profit made by an individual or businesses from the sale of stocks, bonds, or real estate. Number 4, property, a tax paid by the owner of the property which is assessed based on the market value of the property or land. Number 5, inheritance. As the word implies, it is the tax on inherited estate of a deceased person. And number 6, sales, tax imposed on the sale of goods and services, such as the value-added tax that appears on the cash sale receipts. Now, let us discuss the most common taxes: income tax versus capital gains tax. Warren Buffett is the 5th richest man in the world. He is CEO of Berkshire Hathaway, which is a holding company and owns around 60 more companies like insurer Geico, restaurant chain Dairy Queen, and battery maker Duracell. Buffett also owns a lot of stocks in other companies like Bank of America, Kraft Heinz, American Express, Apple, Coca-Cola, and other companies. When stocks of those companies increase, Berkshire Hathaway stocks correspondingly increase too. Buffett took over Berkshire Hathaway in 1965 with the price of $19 per share. Today, the share is worth $474,050, which is almost $500,000 per share. It has tremendously multiplied to 24,950% in 57 years. Buffett owns nearly 240,000 of these shares. Therefore, 240,000 shares multiplied by $474,050 per share are equal to $113 billion. Currently, Warren Buffett has a net worth of $116.7 billion. Obviously, his wealth comes from those stocks in Berkshire Hathaway. Amazingly, Warren Buffett's secretary pays a higher tax rate than Warren Buffett. She pays twice the rate Warren Buffett pays for taxes of his stocks. This is because he pays capital gains tax on those stocks while his secretary pays income tax on her salary. Studies revealed that over the last 40 years, the after-tax income of the rich has increased to more than 400%, while the middle-class income has only increased to 50%. Definitely, there is a big difference in income between the rich and the middle-class earners in the US. This inequality between the richest Americans and the middle class has been growing over the years. Generally, this disparity applies to most countries in the world, not only in the US. Considering the way how the income was earned is very disheartening. The rich practically do not work. They just wait for their stocks to increase in value, while the rest of the low-income earners desperately work hard to earn the income heavily taxed by the government. According to another survey, a maximum of 66% of the population are middle income while 15% belong to the upper income group. Mostly have normal jobs and they pay income tax of 10 to 37% tax rate. Warren Buffett belongs to the 15% and his wealth comes from investments which are taxed as capital gains. Long-term stocks have a maximum tax rate of just 20% in comparison to the income tax rate of 37%. Here is a more solid example. Some stocks were sold for $400,000 with a capital gains tax of $50,000. A salary income of the same amount of $400,000 at the tax rate of 20% will be paying $80,000. That is higher than $30,000 or 37.5%. Let's say Warren Buffett were to sell his 240,000 shares of stocks. He will have to pay capital gains taxes of $14.2 billion based on net profit. That is, the cost of the stock minus the original investment. Assuming that Warren Buffett purchased all the 240,000 shares in 1965, the computation will be 240,000 shares of stocks multiplied by $19 per share in 1965 is total to $4,560,000. 240,000 shares multiplied by $474,050 per share current price is total to $113,772,000,000. $113,772,000,000 minus $4,560,000 investment is total to $113,767,440,000 net profit. $113,767,440,000 multiplied by 12.5% tax rate is total to $14,220,930,000 capital gains tax. On the other hand, let us assume that Mr. Buffett does not sell his stocks until he dies. Whoever is the heir or heiress to such huge inheritance of stocks would only pay taxes after inheriting the stocks. On the contrary, it has been mentioned that Mr. Buffett will leave most of his billions to charity. The original capital gains tax, which is $14.2 billion that Mr. Buffett should have paid enormously, will evaporate into thin air. This is one sure strategy of the wealthy to avoid paying income tax: buy, borrow, and die. This is called the stepped-up basis, which is the big excuse in capital gains taxes that the rich exploit. Warren Buffett is so wealthy because of the stocks, but it is not taxable cash. Just like Mr. Buffett, Amazon's Jeff Bezos, the second richest man in the world, pays almost nothing in taxes because of his Amazon stocks. This is one way billionaires are able to be technically wealthy but pay very low taxes. Some billionaires like Elon Musk are able to get loans against their stocks and live off on those debts. They don't even need to sell the stock to make it into functional money. No sale, no taxes to be paid. In fact, a billionaire does not need any income. So why does the government do not increase tax rate on capital gains? What is the reason or justification behind very low capital gains tax on stocks? There are 3 reasons. First, it is not indexed for inflation. Second, it is a double tax. Third, it encourages present consumption over future consumption. Increasing the rate of the capital gains tax is an easy way to tax the rich. President Biden has already proposed closing the stepped-up alibi and increasing the maximum tax rate from 20 to 39.6%. This is only applicable for those earners with more than $1 million annual income. This may discourage investors in the stock market, or that there would be lesser sales of stocks. It would also mean Buffett and other stockholders would pay a closer tax rate to a salary income taxpayer. There are a lot of things that could be done to make the tax system fairer. Taxes on wealth and increased gain taxes on stocks could be done. Most Americans realize that wealthy people don't pay their fair share of tax. Moreover, increasing capital gains taxes is not the entire solution. The current system is making the rich tremendously richer and everyone else struggles to live with middle income, which is taxed by the government. People who own shares of stocks in profitable companies like Berkshire Hathaway, Amazon, and Apple may be imposed a higher tax rate. The middle class or low-income group can be taxed at a lower rate. This would facilitate more balanced income in the economy of any government. To completely avoid paying income tax, you may work as an expatriate to some countries in the Middle East. These countries have zero income tax, which includes the Kingdom of Saudi Arabia, United Arab Emirates, Oman, Kuwait, Qatar, and Bahrain. These are Arab oil-producing nations that subsidize their finances through oil export rather than taxes. You may enjoy life working in an Arab country without paying income tax. There ends our video for today. Share with us your thoughts on how to avoid paying taxes on the comments below. We will be glad to read and reply to your comments. We will see you next time on Remarkable Finance. We upload videos every other day. Please do not forget to like, share, and subscribe. Check out other videos from our Remarkable Finance channel. Thank you for watching. Masalama.